Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you minimize your losses and keep more of your profits through our proprietary market signals that are emailed to you every weekend. Today is Tuesday, March 10th, and we will be doing a technical analysis on the S&P 500 on this video. First thing I want to point out is we were up 4.94% today, closing at 2882.23 on the S&P 500. And what we're looking at here is a 1-month chart where each candlestick represents 1 day of trading in the S&P 500. And for the charting service, we will be using stockcharts.com. I will leave a link to their site in the description box below this video. If you look in the lower right-hand corner of the chart, you can see today's trading here. And one interesting data point is we went down and kissed the lows of yesterday, bounced off of that, and of course closed at the highs of the day. So, good day for sure, and it got us back over that 28.55 level, which any of you watching my videos for the last few weeks know that this 28.55 level is a very, very important level, and it's easier to see that on this chart. The 28.55 level up till yesterday had been the lowest point that we had hit during this downturn, and it was also the same level, the same low, if you will, that we put in for the entire month of October of 2019. And you can see back in August of 2019, there was a lot of trading around that 28.55 level as well. So the 28.55 level is a very, very important support level, and the fact that we're back above it is definitely encouraging. However, what has really changed? And also, these huge up and down movements, over 7% down yesterday, almost 5% up today. I always look at these with suspicion. And huge swings like this and huge up days like these and like these days that we had last week are generally found in more bearish environments. As a matter of fact, if you kind of look at the size of the candles going up from where we touched those lows in October, and then we had that very nice run, see how short those candles are? They're, just a nice little steady, boring ride up, okay? So the shorter candles are found and the less volatility is found in a more bullish environment. The longer candles, the more dramatic swings, both up and down, are generally found in unfavorable environments. So, could we have at least put in a short-term bottom here in the last couple of days? I suppose it's possible. I definitely would want to see follow-through here over the next couple of days. So, can we trade above and keep above 28.55 and close above 28.55 for the next few days in a row? If we can, that will be very positive. But guys, this environment, and I'm not talking about just the coronavirus. There's so much going on in the oil markets, and that could affect and will affect numerous countries around the world. And the low oil prices will have a negative impact on states like Texas and Colorado, which, there's a lot of oil production in those states, either through, regular drilling of wells and or shale. So, we don't know the spillover effect yet of all of this. And bond yields have fallen to unrealistic levels. So there is just so much going on here now. It's kind of a perfect storm. And as I pointed out last night, it kind of feels like we're in a negative feedback loop. And once you get those dominoes falling, you start to experience that domino effect. You get one domino falling after another. It's really hard to turn that around in the short term. So I would be very, very cautious in thinking that we've put in the bottom here. Is it possible? Yes, because this 27.50 level is a very, very important level. And as I pointed out on last night's video, and I don't have it on this particular chart, but the 27.50 basically is where we started 2018. So the first time we ever hit 27.50 was in the first part of 2018, and I showed that on last night's video. But you can see here that 27.50 was a support area back in May and June. We had 27.50 back in March of 2019. A lot of trading in 2018 and Q4 of 2018 around that level. So the 27.50 is very, very critical. So, again, it was encouraging to see that and you can see that here, we literally went down and easier to see on this chart. We literally went down and touched those same exact levels today that we saw yesterday, bounced off of those, finished at the high. So for the, in the near term, it's very encouraging. But I also pointed out on last night's video that this was highly probable in that we had such a down day yesterday that it's pretty normal to see a snapback, at least some kind of a recoil the next day. Again, the question is, do we get follow through, or does it start to look like this pattern or this pattern here where we get a lot of chop and a lot of back and forth? And again, I'm very suspicious about these huge, 4+, almost 5% up days, because they're generally followed by more volatility. So I would be very, very cautious here. I do think that the worst is yet to come. I think it would be, given the uncertainties around the globe surrounding the oil markets, the coronavirus, and other issues, and then the spillover effect of all those things, entire countries, Italy, quarantined. So, guys, there's so many unknowns here that I think it would be naive for us to think that the worst is behind us when it comes to the stock market. I would be very cautious here. Especially the next few days, I think, at least for the short term, could be very telling. Can we stitch together 3 days in a row, 3 positive days in a row, and stay above this 28.55 level? If we can, that's going to be very positive. But I doubt it. I doubt it. Now, let's talk about a couple other things here real quick. So if the 2750 level does not hold and we break below 2700, that puts us in a bear market. The actual number is 2708.94 as per my calculations, and that's a 20% drawdown from the peak that we hit back on February 19th at 3386.15. So instead of drawing the exact number again, which is 2708.94, I just put the line at 2700 because that's easy to remember, okay? So right here. So anything below 2700, and we're in a bear market on the S&P 500. And there's not a lot of support. Once we get below 2700, it would be very easy for us to get down to this 2350 level again, which is the low that we hit around Christmas time in 2018 before we started this run here. So again, my gut feeling, based on the technicals, based on looking at what's going on a global scale, all of the uncertainty, and I would be very surprised if during this correction, this downturn, we don't see at least 2350, if not lower, on the S&P 500. I will be pleasantly surprised if we don't see that. So be careful. Again, if you haven't taken profits and put some cash on the sidelines just yet, it's today gives you a pretty good opportunity to do that. I would be, again, very, very surprised if the lows are in yet. Possible, yes, but I think it would be too easy and too convenient. These types of drawdowns generally don't resolve themselves in just a couple of days like this, okay? So at the very least, I think we need some sideways chop like we saw back in August. And then you can see here we tried to rally, pulled up, and then came back and retested that area again back in October, and then the real move happened. So this is a pattern that works, right? You go down, you kind of back and forth, back and forth, back and forth. You try to break out, the breakout fails. You go down, hit that, retest those areas, and then the real move happens. So again, this whole movement, 2 days apart, double, just to think that this is that we double bottomed here and this is it. Possible, yes. And it would look like this, right, back at the end of 2018 if that happens. But man, so again, it's possible, guys, but I don't think it's very probable given our current circumstances and all the uncertainty around the coronavirus and the economic impacts and the spillover. And so again, just be super careful and remember that this isn't the type of market where you want to try to be brave. And it just reminds me, and I'll close with this, it reminds me of my dad was a big aviation enthusiast all of his life, and so I've been around planes and things all my life, and I learned a saying from the aviators that there's old pilots and bold pilots, but no old bold pilots. And so I think we can use that in our business and in trading and investing. There's old traders and bold traders, but there's no old bold traders. So right now is not a time, in my opinion, to be bold. Okay? If you want to be an old trader, if you want to be able to trade for a long period of time, keeping your capital together is priority number one. And this market, I believe, has the potential to take a lot of capital from a lot of people. So keep your capital intact. Don't try to be a bold trader. Live to fight another day. Live to be an old trader.